Let's dig into the decision to pause rates and the ramifications for your money and the economy with Euro-Pacific chief economist and Peter Schiff Show podcast host Peter Schiff, along with Nataline Securities global fixed income head Andy Brenner. Andy, first to you, your gut reaction to this. He kind of calmed the markets at one point, and then all bets were off.
Liz, he was waffling all over the place as far as Peter was talking about what Powell was saying about labor, and it's really ridiculous. The labor market is softening. We saw it in the unemployment numbers, not the headline last week, or 2 weeks ago rather, and he was all over the place. 2 years rallied from 478 high yield to 469. Now, as you just said, back to 472, 473. We really think inflation, we looked at the PPI number this morning, 1.1% year over year. Why doesn't that factoring in any of the Fed's discussions? You know, we're looking at lagging CPI data, but even Powell said that he thinks that the committee thinks it's going to be 3.9% for PCE year over year. I think those numbers are going to end up looking very high. I think they're going to be significantly lower.
I think this is what's shocking, that the numbers that they put out for the projections, which only come, how many times do these projections come out?
Once a quarter.
Once a quarter. We got the brand new ones. They look better and stronger, particularly for GDP. If you look at GDP, previous was 1%, 0.4%, 0.4%. Can we put this up? Because this is extraordinary. They have raised it now to 1% by the end of this year. Then you have for 2024, 1.1%. And now, of course, 1.8% for 2025. So why pause now, Peter?
Well, I think Powell is actually concerned about the evolving financial crisis that has only just gotten started. I think it's going to ultimately exact a heavy toll on the real economy, on the so-called strong labor market. I don't believe that this is a hawkish pause. I mean, Powell admitted that the risks to inflation are still to the upside. He talked about how important it is to get inflation down to 2% and how far away we are from achieving that goal. He's forecasting 2 more rate hikes this year. If that's the case, why skip? Why not raise rates right now? If inflation is still a threat and you know you're behind the curve, raise rates. I think Powell's afraid of what's happening in the economy. He doesn't want to hike rates anymore. He realizes that the rate hikes have already been too much for this fragile economy to bear, but he doesn't want to admit that. So he wants to maintain this specter that the Fed's still on course. To me, it's like that mid-course correction from 2019. I knew at that time that it wasn't a course correction, it was a course change, and that is exactly what we've had.
Volatility is dropping. We now have it straddling 14 points. Okay, it's been below that in the past couple of days as well, but down 4% at the moment. So seems like the market is comfortable with this. But Andy, there was a point where specifically he stressed, and this was not there yet. We're not there yet on tackling and killing inflation. Let's listen to how he put that. And then I need your response on that, because like Peter said, why then pause? Because what you have when you pause is now you're stopped and you've got an inner thing and you've got to get the energy to start it back up again in July if necessary. Here's what Powell said.
Forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down and typically forecasted that it would and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level, over 4.5%, far above our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We want to do that with the minimum damage we can to the economy, of course. But we have to get inflation down to 2%, and we will. And we just don't see that yet.
And yet he's pausing. What are our viewers supposed to interpret from that?
First of all, Powell is a dove in wolf's clothing, always has been, always will be. But Peter hit it right on the head. It's the regional banking system. They're in tremendous distress. Sure, it hasn't been in the headline for the last few weeks, but just look at Treasury bills. If the Fed's going to raise rates further, T-bills are going to be between 5.5% and 6%. Why would anyone in their right mind keep money in bank deposits at 3% or 4% or 1%?
What do you mean 3 or 4? They're still at zero. No, Bank of America is zero on checking and 5 basis points on savings
Apple Card
account.
isn't. Citi isn't. Capital One isn't. I just
still makes a
put
great
money
point.
into 4. Okay, I get that. But you're right about when you look at the short-term T-bills, right? Anything from 1 month, 3 month, we call it the party of 5%. Like 6 of them up until 1 year are all yielding 5+%.
Absolutely.
Why would that go higher?
And Powell is significantly downplaying the risk in the commercial real estate market. This is a crash already happening in slow motion.
Why are regionals going down?
Well, first of all, they're all going down because why even keep your money in a bank that might fail? They're all insolvent. When they bailed out Silicon Valley Bank and a couple of others, they made it clear that it's a case-by-case basis whether they're going to cover accounts in excess of 500 or the 250 limit. The government has created a run on the regional banks, on the community banks. They are disasters. The only thing that's really propping them up now is the Fed and the government. But also, Powell is significant.
All of these regionals are reverting. They had been in the green. They are now going red. Yesterday on this show, Duke professor Campbell Harvey, who invented the term yield curve inversion, which, by the way, at this point, Charlie Brady, our managing editor, is saying that the yield curve inversion is the widest in 3 months. It is a huge gap. And that is a screaming sign of recession. And yet all we see are these so-called points of strength. The Fed is pausing. I mean, this looks, like I said, 50 shades of gray.
The banks are loaded up with low-yielding, long-term debt, whether it's mortgage debt, Treasury debt, and they're losing their deposit base because their depositors are not going to take the risk of the bank failing. They can't get any yield. They can just pull the money out and loan it to the government by buying a money market fund. The Fed created this disaster by keeping interest rates at zero for about 14 years, for running up a $9 trillion balance sheet. If Powell really thought inflation was a big risk, he shouldn't have lit the match.
Andy, do you think Jay Powell, looking at the Fed funds futures leading up to today, where they got as high as 98% for a pause today, do you think he was influenced by that, and that's why he paused?
I think that was part of it, Liz, but I think he was going to pause regardless. I mean, when he had Jefferson go out there 2 weeks ago and say, we're going to pause, that was it. He had already made the decision. And CPI really wasn't going to change that no matter what the number was. The problem that they have now is Powell had 2 people that were ready to dissent. So that's why he tried to sound hawkish. That's why they did talk about 2 more rate hikes. I think they're done, and done. And one last thing with regional banks. Remember, when you put money in Treasury bills, if you live in a high-tax state, that is non-taxable for state tax, which makes it even more valuable.
Well, they're only done until the market forces their hand, because eventually inflation is going to run out of control and the Fed is going to have to hike. But the one thing that Powell could do that would help is to warn Congress that they got to cut back on this reckless government spending, bring down these deficits. That's one thing that might make a difference. But he cops out. He refuses to go there because he says that, well, fiscal policy is not part of what he does. It's exactly what he does, because it's the monetization of those massive budget deficits that is the root cause of the inflation that the Fed creates.
Dow Jones Industrials down 269 points. The S&P lower by 5. NASDAQ's holding on to tiny bit of green, a gain of about 3 points here. Apple's moving higher. We do have several increases here, and up to 52-week highs on the stock market. Let's get to individual names. Andy, Brenner, Peter Schiff, great to have you. Thank you so much.